Welcome to the Wealth Blueprint, your trusted guide to mastering market dips and building financial resilience. Let's dive in. A stock market correction is a normal and even necessary part of the investing journey. While it can feel unsettling in the moment, corrections are a sign that markets are functioning as they should, adjusting to new information and recalibrating after periods of rapid growth. If you've ever watched your portfolio dip and felt a knot in your stomach, you're not alone. Corrections can be emotionally challenging, but they're a common experience for anyone who invests in the stock market. In simple terms, a correction is when the market drops by at least 10% from its recent high. This decline can happen over days, weeks, or even months, and it often feels dramatic in real time. It's not a crash, but it's enough to make even seasoned investors uneasy. The uncertainty can lead to second-guessing investment decisions or feeling pressure to act quickly. Corrections happen regularly, triggered by a variety of factors: economic news, geopolitical events, changes in interest rates, or simply markets overheating after a period of optimism. Sometimes, even rumors or speculation can set off a wave of selling. The collective mood shifts from optimism to fear, fueling a cycle of selling as more investors rush to protect their gains or limit losses. This emotional response can amplify the downturn, making corrections feel even more intense. But corrections aren't a sign the system is broken. They're a healthy feature of markets. They serve as a reset, allowing prices to return to more reasonable levels and preventing bubbles from growing unchecked. They wash out excess speculation, cool off overheated sectors, and create opportunities for disciplined investors to buy quality assets at better prices. Corrections also remind us that investing always involves risk. No matter how strong the market seems, downturns are inevitable, and understanding this helps set realistic expectations. Accepting this reality is the first step to navigating these periods successfully. Instead of reacting impulsively, focus on your long-term strategy and remember why you invested in the first place. For long-term investors, a correction is just turbulence on a longer journey. Like a plane hitting a patch of rough air, it may be uncomfortable, but it doesn't mean you're off course. The fundamentals haven't changed. Your destination remains the same. Over time, markets have historically recovered and continued to grow, rewarding those who stay the course. The key is not to panic or make rash decisions mid-flight. Emotional reactions can lead to costly mistakes, while patience and discipline are often rewarded. Stay buckled in, the storm will pass, and your journey toward financial goals will continue. Remember, corrections are temporary, but your commitment to your plan can make all the difference in reaching your destination. When the market drops, you have a choice. You can see it as a painful loss, or you can view it as a rare discount. This simple shift in perspective can make all the difference in your investing journey. Most people react with fear, focusing only on what's vanished from their portfolio. The red numbers and falling charts trigger anxiety, making it feel like all your hard work is slipping away. This fear often leads to panic selling. Investors rush to sell their holdings, locking in losses and missing out on the eventual recovery that markets historically deliver. The headlines amplify the sense of doom, making it even harder to stay calm. But there's another way to look at it. A smarter, more strategic mindset is to see the dip as a rare sale on quality investments. Instead of running from the market, you can look for opportunities hiding in the chaos. Imagine your favorite store suddenly offering everything at 20% off. You wouldn't panic. You'd see a chance to buy more for less. The same logic applies to investing. A market downturn can be a golden opportunity, not a disaster. Investors who view corrections as discounts are able to buy great companies at better prices. They understand that the market's mood swings don't change the underlying value of strong businesses. This mental shift is crucial for long-term success. It's about training yourself to see opportunity where others see only risk and to act with intention rather than emotion. It requires conscious effort to focus on value, not just price. Price is what you pay in the moment, but value is what you receive over time. Learning to distinguish between the two is a skill that separates average investors from great ones. The price is what you pay. Value is what you get. When you buy quality at a discount, you set yourself up for future gains as the market recovers. During corrections, prices often fall below the true long-term value of companies. This is when patient investors find their best opportunities, when others are too afraid to act. Reframing your perspective in these moments separates you from the panicked crowd. It allows you to make decisions based on logic and research, not fear or herd mentality. Act with calm, rational logic, like a true business owner. Remember, the best investors treat their portfolios like businesses, not lottery tickets. That's how you build real wealth through volatility, by staying calm, focusing on value, and taking advantage of discounts when others are running scared. A loss isn't real until you sell. Until then, it's just a paper loss, like your house's value dropping on paper, but you still live in the same home. The same goes for stocks. If the price drops, you still own the same shares in the same company. The business hasn't changed overnight, only the market's mood has. Selling in a panic turns a temporary dip into a permanent loss. Market fluctuations are just noise, not a reflection of true value. Don't let short-term pessimism dictate your long-term outcome. When your portfolio drops, remember, nothing is lost unless you sell. The numbers on the screen are just opinions for that day. Your ownership in real businesses remains. Resist the urge to make paper losses real. That's your main job as an investor during a correction. During corrections, financial media thrives on fear. Sensational headlines and dire predictions grab attention, not inform. This cycle of panic headlines and investor anxiety feeds further selling. The media's goal is clicks, not your financial well-being. Their dramatic stories distort reality, making normal events feel catastrophic. The best defense? Tune it out. Spend less time on news, more on your investment plan. Protect your capital from emotional reactions fueled by media noise. If you're fully invested, the best move during a market correction is often to do nothing at all. It might sound counterintuitive, especially when headlines are screaming and your instincts are telling you to act. But sometimes, the wisest action is simply to stay put and let your long-term plan work for you. This goes against every instinct we have as investors. When markets drop, fear and anxiety can take over, making us want to do something, anything, to regain control. But acting on fear usually leads to mistakes that can be costly in the long run. Constantly buying and selling in response to market swings erodes your returns through trading costs, taxes, and poor timing. Even experienced investors struggle to consistently predict the right moments to buy or sell. Selling after a drop locks in your losses, turning a temporary decline into a permanent setback. And once you're out, it's emotionally and mentally tough to decide when to get back in. Most investors who sell in a panic miss the rebound that often follows. They end up buying back in at higher prices, missing out on the recovery and compounding their losses. Remember, your portfolio was built for the long term. A correction, while uncomfortable, doesn't change your goals or the reasons you invested in the first place. The companies you own are likely still fundamentally strong. Only their stock prices have changed in the short term. Market volatility doesn't erase the value of solid businesses. Patience is your most powerful tool as an investor. By resisting the urge to react impulsively, you give your investments the time they need to recover and grow. Avoid checking your portfolio obsessively. Constant monitoring can increase anxiety and tempt you to make rash decisions that undermine your long-term success. Trust the plan you made when you were calm and rational. Your investment strategy was designed to weather storms like this. History shows that every correction is eventually followed by a recovery. Over time, markets have always bounced back, rewarding those who stayed invested. Staying invested is how you benefit from that rebound. The biggest gains often come right after the worst declines, and missing them can set you back for years. Remember, doing nothing isn't passive. It's an active, disciplined strategy that takes courage and self-control. Sometimes, the best way to protect your future is to simply stay the course. If you have extra cash, a correction is your chance to buy quality assets at a discount. Don't try to time the exact bottom. No one can. The market often rebounds before it feels safe. Use a staged approach. Invest in chunks as the market falls further. This is dollar cost averaging, adapted for volatility. If the market drops more, invest more. If it rebounds, you're already partly in. This removes the pressure of perfect timing. You'll build a position at an attractive average cost. Turn fear into a systematic plan. That's how successful investors act in downturns. Some are tempted to use borrowed money to buy during corrections. Leverage amplifies both gains and losses, but the risks are enormous. If the market keeps falling, you could face a margin call and be forced to sell at the worst time. This can wipe out your investment and more, even if your long-term thesis is right. The stress and risk of owing money during a downturn lead to bad decisions. Investing is about using capital you can afford to leave untouched. Never gamble with borrowed money. The potential reward isn't worth the risk of ruin. Stay in the game for the long haul. Avoid leverage. Thriving during corrections isn't about bold moves, it's about discipline. Wealth is built through steady, consistent investing, not market timing. Your behavior in downturns matters more than your stock picks. Even average investors succeed by sticking to their plan and not panicking. Trust your system, your asset allocation, savings rate, and schedule. Don't let fear masquerade as insight. Avoid big bets or abandoning your strategy. Focus on what you control. Keep saving, keep investing. Deploy extra cash gradually. If fully invested, do nothing. Boring discipline beats emotional speculation every time. Navigating corrections comes down to a few key principles. Corrections are normal and create opportunity, not disaster. Your mindset determines your outcome. See discounts, not losses. Paper losses aren't real unless you sell. Tune out sensationalist media. They profit from your fear. If fully invested, practice disciplined patience. If you have cash, invest it gradually. Don't chase the bottom. Never use borrowed money. The risk isn't worth it. Your temperament and long-term view are your greatest assets. The market will recover. It always has. Stay calm, stay invested, and let time work for you. If you found this guide helpful, don't forget to like, share, and subscribe to the Wealth Blueprint for more insights. See you in the next video. And remember, your support helps us bring you even more valuable content, so hit that like button, share with your friends, and subscribe to stay updated.